Morning, everyone. David Moore here, and sorry for the delayed start. And it looks like you're not going to see me this morning either, but it's one of those things. New computer, new technology, always got to love that stuff. So we're going to get started. First time I have presented this class, and I am going to do my best to keep us on schedule. I'm just going to apologize in advance. It's probably going to run over, but I think we've got some good information, and hopefully you'll get a few good old nuggets of knowledge out of this presentation today. So there's a lot of things. I've been doing this for over 30 years now, and there's a lot of things that are said that are just wrong. So that's the title. This presentation is 1031 Exchange Fallacies. My father used to say, anytime you read something about something you know something about, you know how wrong it is. So it's really interesting in today's world. We've got all these different, gurus and these different things that put out lots of information, and so often I'll sit there on YouTube or just research something on the web and start reading about some aspect of 1031 or self-directed retirement accounts or just investing in real estate, and whoever's putting that content out is just like, where are they getting that information? So we're going to dispel a few fallacies today. Going to talk about a variety of different things. We'll finish up with a couple different examples. But if you've got questions, I probably won't get to it during the class. So if you've got questions, on the right side, there's a little drop-down menu. You can post them there. If you are in Oregon, we are able to provide continuing education for you. So please reach out to CMOORE, C-M-O-O-R-E, at 1031exchange.com for any CE needs. And if you've got questions, please don't hesitate to post those on that sidebar, and we will get back to you with responses after the class. So away we go. Why do we even think about an exchange? Why do we think about Section 121, the universal exclusion? And something else I really want to mention, we don't have any content on this presentation regarding it, but Section 1033. 1033 is involuntary conversion. So, for example, if you've got a piece of property that's city, state, I've got a couple clients right now actually that had hotels and motels that cities are taking and putting people in. And in those situations, 1033 should be a viable option. Now, it's sort of entertaining to me because I have even tax and legal professionals that reach out to me saying, hey, I need a 1033 done. You don't need me for a 1033. 1033 is an automatic deal. 1033, if you compare it to 1031, if you've got a condemnation situation coming up, really talk to your tax or legal people about the possibility of applying 1033. The biggest benefit to 1033 over 1031 is any of you on this call that have done it in an exchange, time is the biggest headache with the transaction. You've only got 45 days from settlement to ID, 180 days total time to get it done. And you've got to be careful late in the tax year, that 180 might be trimmed also, because if you read the fine print 1031, it says 180 days are the due date of the tax return. So you got to be careful with that stuff. But 1033 has up to 2 years from the due date of the tax return to buy like-kind replacement property. And if the 1033 is via condemnation, the like-kind rules are the same as 1031. You've got to be careful because fire, conversion, stuff like that, you've got different, that's going to be similar in service and use. But if we're looking at just a condemnation by a municipality, you should have the same rules as far as like-kind with 1031. So they're really a nice thing that fits there, and it's something to look at if you're in a situation where you're losing a property through condemnation. But this gain thing, really gain has nothing to do with profit, and I got to stress that gain has nothing to do with profit. And in fact, in short sale or foreclosure, you can actually have tax exposure via something called phantom gain. So gain in the most basic sense is simply the adjusted sales price minus the basis. Your basis as a property is what you paid for it, plus the capital improvements minus the depreciation. Now, I've got to caution you because each of those things, the purchase price, that varies. That's not, if you pull money out of your pocket, the purchase price is that purchase price number. If you were to do a 1031, you've got a basis carry forward. 1033, it's basis carry forward. The old 1034 residential rollover is a basis carry forward. So you've got to understand that that initial quote unquote purchase price varies depending on how you got that property. So once again, if you just pull money out of your pocket, go buy something, that purchase price is clearly the purchase price. So the next piece is improvements, right? And during the time you own a property, everybody that's got a piece of property is spending money on that thing. And you've got to look at it. And this is, I'm just going to say we are one part of a successful team of investment professionals in your life. And our job is to take what you don't want and get you what you do want, right? So you're paying us a fee to structure an exchange, you're selling and buying, we're turning that process into an exchange. Brokers, obviously brokers that understand this process, that are familiar with the process, understand how to push, work, time, all that, that's going to be critical. Good tax and legal people. Good tax people, I think, are the most important people in your life when it comes to all of these different things. Because, you know, having tax exposure is one thing, taxes owed is a totally different thing. So really get good tax people. Don't just pay somebody to prepare a tax return for you. If you've got income property, you owe it to yourself. Don't be put off by the cost of engaging somebody in that space. Understand that you're working with somebody, they're going to save you way more than they're costing you. So really get good tax people. And an example might be, recently I had a situation where, well, I'll get to this in a second, but the improvement component, every dollar you put into something, you're going to expense or capitalize. If you expense it, you write it off. You capitalize it, increases the basis. Where I was going to go with that good tax counsel comment is depreciation, all right? Now, depreciation is one of those things, it's not elective. So if you buy a let's say, even if it's a simple rental house, a couple comments. One, what are you depreciating? You're depreciating typically the improvements. Cost segregation might be a situation where you're depreciating all the different components of those improvements. So cost seg sort of accelerates depreciation, and really any institutional offering is going to utilize that. Real estate investment trust, REITs, DSTs, Delaware Statutory Trust, institutional TICs, Tennessee in Common, they're all going to use cost seg. But if we look at cost seg in the most basic sense, it would be a rental house and you've got an allocation dirt to the improvements. Okay, now what's important is who makes that allocation? The greater the value of the improvements, more depreciation you're going to take, the better ultimately your return on investment is. So it makes a huge difference what your allocations are. So don't just flippantly do an allocation based upon whatever the tax statement says it might be, for example. That's where you're going to rely on your tax people. Don't just call them up April 15th for a tax return. Really work with these people year in, year out. If you're contemplating a sale of anything, talk to them immediately and get an idea what your tax consequence is going to be on disposition, because 1031, there's an opportunity cost to an exchange, especially in today's time, because you know what's going on with the market. Can you find something at 45,180? But when we look at depreciation, the thing I want to stress is that it's not something that's just optional. If you've got a rental house, the government's position on that depreciation is you should have taken it, therefore you did. So I want to stress that it's not elective. So if you've got a rental house sitting there vacant without rent, then you're not taking it. But as soon as you start renting that thing out, by law, you're taking depreciation. And unfortunately, I had a few people recently where they're looking at a situation where they didn't take it, and if they didn't do an exchange, they were going to get clobbered with that depreciation recapture. So it's really important that you're working with people who are going to take care of you, not just to get that depreciation, but to make sure you're taking the depreciation that you're entitled to, because it ultimately is going to impact your return on investment dramatically, and your tax consequence upon disposition. So gain is, once again, in a nutshell, the purchase price. You're going to take that basis, your purchase price plus capital improvements minus depreciation, and that number, the difference between the adjusted sales price and that basis, is going to be the gain. So once again, the adjusted sales price minus the basis gives you gain in a short sale or a foreclosure. you're sorry, I'm a little bit convoluted. This I'm really excited about it this morning for some reason. But phantom gain is something where in a foreclosure short sale, the sales price is really going to be your debt on the asset. So if the debt exceeds the basis, you could lose a property to a short sale or foreclosure and actually have to pay tax for the pleasure of doing so. So we've done a number of transactions through the years where we've got a phantom gain situation where property was lost, especially during the last recession. It took us about 10 years to mop up that situation where people had foreclosures happening and their choice was pretty simple. They would take that debt. If the debt exceeds the basis, that delta is the gain. They'd figure out what their tax consequence is going to be. And quite honestly, a lot of the time, the tax consequence in that situation was greater than if they pulled money out of pocket. And you're thinking, well, gee, you didn't get any money out of the transaction. How can I have tax exposure? Well, what happens is we're taking ownership of the property pre-foreclosure. When it goes away, it's ours, not yours. We isolate you from debt relief, not gain, attributable any actual boot received other than that debt relief. So a lot of times the tax consequence actually exceeded what somebody would have to come out of pocket to go out and buy new replacement property. So once again, in a foreclosure, the sale happens, no money comes to us. We have just isolated that taxpayer from debt relief, therefore that gain associated with that, and then they would show up at the purchase of the replacement property or properties with the cash required to make that purchase. And if you look at the loan to value, that loan to value is a lot of times something that was maybe in excess of what that tax consequence might be. So in other words, their down payment would be less to go buy something what they would have to come out of pocket to pay the tax for the pleasure of losing that thing. So long story short, gain has absolutely nothing to do with profit. It has nothing to do with actual net proceeds coming out of a deal. It's simply a tax calculation that is the adjusted sales price minus that basis. And once again, the basis is what you paid for it plus the capital improvements minus the depreciation. So what's that cost you? If you bought and sold something and you did an exchange, or you didn't do an exchange and it was held for under a year, you're going to pay normal income tax on that. So on the federal level, you're paying normal income tax, you're going to pay state tax on top. If it's something held for in excess of a year and held for investment, then you're looking at typically, most of our clients are looking at 20% Fed on appreciation, 25% Fed on depreciation recapture. State tax could range anywhere from 0 to 13.3 if you're lucky enough to be living in California. On top of those numbers, you still have the healthcare tax that might hit you also at another 3.8% on top. So you could be in a situation where you're looking at almost a 40% tax hit, even if it's a long-term capital gain. If it's normal income tax, it's going to be a lot more than that. So good tax people are very, very important because once again, as I said earlier, tax exposure is one thing, actual taxes owed is quite another. So they're going to look at, you might realize a gain on the disposition of the property, you might have losses on maybe the stock market somewhere else, so you can offset the gains with losses, so on and so forth. So it's really important you don't just fixate on that one transaction, really look at your life and figure out how to get where you want to go and while paying the least amount of tax. And we'll talk about the fact that 1031 is not all or nothing either. So you just have to understand what your liabilities are, and maybe you're going down in value, and that reduction in value from the relinquished to the replacement property, that would trigger something called boot and tax on that difference. But maybe you sell in stocks or something else that could offset that and balance it out. So 1031 is not all or nothing. But the whole reason we're looking at this is because of capital gains tax. And this is just a map showing state by state. And by the way, this presentation will be uploaded to YouTube later, and also the PowerPoint for this will be available if you want this in your hot little hands, all right? But this map just shows the United States and the tax rates of different states. Obviously, the gray states are the ones that a lot of money's flowing in and out of right now. We've got a lot of money going in and out of Tennessee and the Carolinas too, but any place where owners have some rights of ownership. I call it the rent control refugees. So we look at states like California, Oregon, Washington, other states where you don't have much in the rights of ownership and the tenants have all the rights. People are just fleeing. I mean, you can't afford, a lot of the mom and pops simply can't afford to deal with the properties that they've lived on for all these years, and they end up moving out of these states into other states where they have more rights, or a lot of times they're going to just exchange into a Delaware statutory trust or something like that. There's a variety of different things out there, even something called a 721 UPREIT, where you're exchanging into a Delaware statutory trust investment, which is totally passive, the classic mailbox money, and then in the future, that property gets actually rolled into a shares of a real estate investment trust. And I look at that sort of the ultimate installment sale, because as you sell the shares of that real estate investment trust, you pay the tax. So you can literally do it anytime you want to do it. Please note also that a couple states, Oregon came up with it, California followed. You can exchange out of the state. At this point, every state in the United States honors 1031. So we used to have, I think the last holdout was Pennsylvania. They didn't follow 1031, so you could, on the federal level, you could defer your tax. State level, they didn't allow you. Today, everybody's following 1031 at a state level, so you don't have that issue. Now, a couple states, namely Oregon and California, they have implemented a strategy to claw back funds that were deferred out. So it used to be possible, let's say, to exchange out of California at max rate of 13.3, let's say into Nevada, for example, and then maybe you hold that property for a year or two and sell it, and you would have saved yourself the 13.3% that California was going to ding you. California is going to, if there's a future taxable sale, if you continue to exchange, you won't have a tax consequence. But if you exchange into one of these states with no state tax and then later sell, thinking you're going to save yourself that state tax, Cali's going to basically claw back what was deferred out. Once again, if you continue to exchange, there's no tax consequence. But if you sell, triggering a tax consequence, at that point, they're entitled to recapture what was deferred out of the state. So just, a lot of these things used to work, they don't any longer, all right? 1031's old at this point. It's over 100 years old, all right? So, I mean, we look at it, and even today, the thing that's entertaining, I was going to say frustrating, really, more so, is that people don't understand that this thing has to be set up pre-close. And something else I've got a slide talking about a little bit later, but we've got a number of people you might have in today's market. You've got sale fails for a variety of reasons, or timelines get stretched because lending goes away or something else might happen. And you got to understand that you can't legally own the new and old property simultaneously. So if you had a transaction where you've got a purchase going, you've timed the sale, it's all going to work out. Now, for some reason, your sale gets kicked down the street and you've got this purchase that has to happen. A lot of times somebody might say, well, hey, just buy it and then do a reverse exchange in the future. That doesn't work, okay? So if you buy that property without engaging an exchange company to structure that exchange, you own both the new and old property at the same time. You can't do that. So it's really critical that before you buy or sell anything, if your intent is to do an exchange, that you engage an exchange company and get the exchange structured, because if you close either a sale before having it set, if you have constructive receipt, you're going to have a tax consequence. If you buy a property without having it structured as a reverse exchange, you cannot receive something already owned as a replacement for property being relinquished. So it's critical that you contact the exchange company before closing on a sale or a purchase if you intend to have those properties as part of an exchange, all right? So really stop, think about it. I mean, I used to do a lot of scuba diving, and in the golden rule in scuba diving is something going on, you stop, all right? Just stop. Think about what's going on in these transactions. Don't be forced into a situation. Ask the question sooner rather than later, okay? Don't let something close, just say, oh yeah, you just do a reverse later. No, you're not gonna do a reverse later. It's too late if you already own the property, okay? This slide talks about just sort of what you're selling And think about this. If it's primary residence, you've lived in it for 2 out of the preceding 5 years, Section 121, the universal exclusion is going to apply. It gives you 250 personally as an exclusion on gain, $500,000 as a married couple. 1031 applies to property that's been held for investment and you're acquiring property with the intent to hold for investment. So you've got two different things there. What might fall in between these? Well, I mentioned 1033 earlier, so that's involuntary conversion, condemnation typically. You might have a situation where you have not lived in the home long enough, so it's really important if you are living in a home and you contemplate a sale, make sure you fit those timelines to be able to utilize the 250 or 500. If you sold a property, 18 months in, 22 months, 23 months into a transaction, you just missed that by a month, you don't get an elective proration of the 250 or 500. So it's really important to take advantage and know those timelines with what's going on. 1031 obvious. So 121, one last comment, it's not what something is at time of disposition, it's whether it fits a 2 out of 5. So what I mean by that is you could be living in a home, you could move out of that home as long as you sold it, as long as you've got aggregate occupancy of 24 out of those, 24 months out of the previous 5 years, you qualify for 121. Now, what's nice is overages beyond the 250 or 500, if you moved out of it, once again, you need to sell within 3 years of moving out to get the 250 or 500, but the overage beyond the 250 or 500 could be shoved into a 1031 exchange. All right. So you can have a single sale with allocations different directions just by usage or by physical. So what I mean by physical, you could have a duplex half owner occupied, that would be the 121 component, and then the investment, the rental portion would be 1031. You could have a large piece of property, that house, the farmhouse and the working land, same situation. A lot of you might be working out of your home these days since COVID, right? So now you're working out of your home, your tax people say, hey, treat that piece of your home as a home office. Now when you sell that home, you've got to make sure to understand those timelines and how long you've been treating as a home office. If you've been treating as a home office for more than 3 out of the last 5 years, you sell that home, you're going to be subject to tax on that piece of your home, or you could do an exchange on that home office component. So this slide I just like because it really sort of, you contemplate a sale, take a look at it. What is it that you're selling? What do you really want it to be? And with time, with seasoning, you can actually move things one way or the other. Cornerstones. All right. I like simple, believe it or not. I like simple. One, it's got to be an exchange. You're selling something, buying something, we are going to turn it into an exchange. You're paying us a fee to structure that exchange. So pre-sale, you've negotiated a sale, you've included a cooperation provision, the purchase sale agreement, and at time of close, you're giving us a property, we're selling it to the buyer. You're telling us what to buy, we buy it, and we give that replacement property to you. A reverse exchange means you're going to loan us some money, we're going to buy an asset, and then when your property sells, the proceeds from that sale are going to come in, we're going to use them to repay the debt we've got to you, and then we're going to transfer ownership of that property to you. That would be an example of a warehouse replacement reverse exchange. There's another variation called a warehouse relinquished reverse exchange. And that transaction involves us going out, we still buy that property for you, we immediately give it to you, the property go away is given to us at that same time, and now we've got 180 days from that transfer to get that thing sold. So that's in a nutshell the reverse. But really, you're paying us a fee to turn your sale and purchase into an exchange. That's what the exchange company does. Two of the items relinquished received have got to be like kind. We've got to satisfy what we call the napkin test, which means we're going to cross her up in value and equity. And finally, we've got to have continuity of vesting. And that just simply means the person or entity that gave us something has to be given something back. And that might sound simple. And honestly, that's the second biggest problem in an exchange, because if, for example, I'm sitting here in Oregon, Oregon's not a community property state. A lot of times people will buy a rental house and they'll get another rental house and they'll get another, and then their legal people say, well, gee, you got to throw them into a limited liability company to protect yourself. So we're not a community property state. So, spouses are not, two spouses in an LLC in Oregon, that's considered a partnership. Partnership interests are specifically prohibited from 1031 treatment. The entity can do the exchange, but the individuals can't. So where that comes to be a problem is We do phase one is what's relinquished. The property goes away, being held by an LLC. Now you go to buy 4 units or less, and your lender's saying, gee, you know, if we buy it in the LLC, the money's more expensive. And so you don't want to do that. So naturally, you want to buy the replacement individually, and we can't do that for somebody, even spouses in the state of Oregon. Now, a community property state, we don't have that issue. Spouses can go in and out of an LLC through an exchange. But that's how easy that vesting piece gets to be a problem. So it's really critical. If you own a property with other people, you talk to your tax people, you talk to your legal people, call us up, ask us questions. But the idea is if the entity wants to go forward, everybody in the entity wants to go forward, great. But if the members want to go different directions, you're going to have to do either what's called a drop and swap or a swap and drop. And that's another presentation. If you'd like more information on that, you can go on our YouTube channel and look at one of the advanced classes, and we're going to talk about that further. We'll probably do a presentation on that coming up too, because it's just something that's, you know, obviously very pertinent to today's marketplace. But this is sort of the way I look at things. Got to be an exchange, relinquish and replacement properties got to be of like kind, got to go across or up, satisfy the napkin test, across or up in value and equity, and then finally continuity of vesting. If we're looking at investing, let's say with an IRA or 401k, it really breaks down to 2 issues. So it's even easier. What's a person want to buy, and who are they transacting between or for the benefit of? So the exchange, all right, swaps, delayed, reverse, improvement, warehousing, all these are different formats of an exchange. Now, you're probably looking at things, sort of looking at and say, okay, well, the context people typically think of is a delayed exchange. So you negotiate a sale, and at close, that property is given to us. We sell it to the buyer. Your 45 and 180-day timeline start the date of transfer, and you're going to be, off to the races to buy what you're going to buy. Now, my advice is, as soon as you have decided you're going to sell something, one, you talk to your tax people, get your tax consequence, obviously, so you know what the opportunity cost is going to be. If you're going to know whether or not, or decide whether or not you want to do an exchange at that point in time. But the idea is, from that moment that you decide to sell, be looking for what you want. And you can go out and negotiate a purchase before the sale happens. That's all fine. You put earnest money down, do everything short of close on it. But just ask for whatever period of time you feel you need to get your property sold to get into that thing. You don't want to wait until your relinquished property closes to start looking, because that 45 days is going to go very, very, very quickly. And we're going to talk about something called 1031-G6 a little later too, with respect to when you can get your money out of a transaction. So it's really important that you're not sitting on the fence waiting around until things close to go find what you want. But these are different formats. A swap's a true swap. You have something, I have something, swap straight across. Delayed exchange, what we typically look at in today's world. Reverse exchange allows us to buy first, sell later. An improvement exchange allows us to buy something and build on it. And then warehousing is any transaction where we're taking title to a property. Typically, it's in the context of reverse or improvement exchanges, but it could also be a transaction where maybe you're taking as consideration for sale a property that you don't want. And what would happen in that situation is the property would come to us along with the cash. Anything else that was used as consideration, it would come to the exchange company. We'd own it. Until typically we're going to sell that thing when we've got the cash from the sale. It's going to be combined with the balance of the proceeds from that sale initially, and now we can complete the transaction. But I want to stress something. If you look at the bold at the bottom of this slide, the exchange happens when the transfer of ownership occurs, all right? So if we're building things, if you've got a situation, and we're doing a fair number of complex transactions building on assets today, when we put either a leasehold interest in a property in place, if it's 30-year leasehold interest or lease with extensions 30 years, that constitutes ownership of real property. When that lease gets put in place, that starts a clock. If we're going to, typically we're looking at hard stops with purchases or sales, but there is a situation where things change. Now, one other word of caution is installment sales, all right? Land sale contracts, note and trust deeds. Land sale contract title doesn't change until the contract's been paid off. So that title doesn't necessarily indicate ownership. Benefits and burdens of ownership, that's what drives the ownership of an asset. And I've had a few transactions lately. Honestly, they're sort of bordering on elder abuse, I feel, that some buyers we've got these wholesalers and different people that tie up these properties, buy these properties, and they tell the seller they'll be buying on an installment sale, and they tell the seller that they don't have to worry about an exchange till the balloon payment comes in. Nothing could be further from the truth. If ownership shifts, that's when the tax consequences is going to be put in place. You might not have the tax until a balloon payment comes in, but you can't sell and carry a note or some type of seller finance and then only do the exchange when you get a balloon payment. And it's got to be structured as an exchange at the time of transfer of ownership. And we'll talk about that a little later when we look at notes and seller finance in an exchange. So simultaneous ownership, I'm going to stress this. We've had a number of transactions that have happened already this year with the complications in financing, and somebody has say, well, just go ahead and buy it today. And then when you sell in the future, at that point, you can do a reverse exchange. You can't do that. All right, that's one of the big fallacies. So you cannot own the new property and the old property simultaneously in an exchange. So if you're in a situation where you've had a sale fail, now you got to buy a property via reverse exchange, make sure that that exchange is structured pre-close, because I mean, if you close that property, you already own it, and then you sell in the future, you cannot exchange into something that you already own. That was put in place in 2000 when we've got RevProc 2000-37, the safe harbors with respect to reverse exchanges. All right, so it clearly states one safe harbors that you cannot receive replacement property already owned. Okay, period. That's it. So if you're in a situation where it looks like a reverse is going to be necessary, make sure you're engaging the exchange company pre-close, because if you own it, it's not going to fit something for a future sale. What can be exchanged? The like kind. Okay, like kind, one of the big fallacies is that, people talk about, well, gee, I remember when it was house for house, land for land. It's never been that way. I believe it was the late 90s with one of the tax reform efforts. There was a proposal to eliminate the 45-day ID period, which I think would be an amazing thing, because I just really despise the 45-day time. I feel like it puts good people in a bad spot. If you got 180 days to get an exchange done, who cares what's been, why should it matter on the 45th day what you're identifying? You're fitting the timelines that they have laid out. But once again, it's not an elective thing. The 45 days is there. Understand that the only way to extend the 45-day ID period is through a presidentially declared national disaster, and we get those things all the time. If you're in the Northwest, I think I can only remember a couple of them ever issued in over 30 years. One of them was for COVID, and the other was for the fires in the year of COVID. So that was just one crazy year. But California, we've had lots of extensions last year. If you're in the South or on the East, and we've got hurricane situations or flooding that comes up, so things happen. Every year there's extensions offered, but they're not elective. All right, you got to be able to document that you were impacted by that thing. But anyway, it's really critical that you take care of that like kind. Understand like kind refers to the nature of the investment rather than the form. So you can go from a rental house into dirt, office buildings, apartments, place at the beach, all those things to retire into someday. All of those things are going to be of like kind. And if you look at the 10 o'clock position on this slide, it also talks about that 30-year leasehold interest, or a lease with extensions to 30 years would also constitute like kind real property. Napkin test. All right, the napkin test says what we have to do to satisfy an exchange, and it just says basically we've got to go cross-rep in value and equity between the relinquished and the replacement properties. Understand that I did not say anything about debt. All right, so a boot in an exchange is anything that's been received that's not of like kind. And if we look at debt on a transaction, debt can go away a couple different ways. Okay, debt can go away by going down in value in a transaction. This is another one of these fallacies. People all the time say, well, I have to replace the debt in the exchange. And once again, understand in a market like we're in, we've got often a property that might have gone down in value, which does what? Decreases the equity that's available. And then we might have a situation, or we're going to have a situation, where we've got a reduced loan to value for those loans that are available today. So inevitably, people are having to add money to a transaction, and somebody's told them, well, you have to replace all the debt in the transaction. That's not the case. It's never been the case. And if we look at the transactions that we're doing, we've got a number of them where people are adding money to the purchase. Maybe they don't even want debt on the replacement property. So, once again, the napkin test says we go across or up in value and equity, and that debt can be reduced in two ways. One, by going down in value, which triggers tax because you went down in value. The second way debt's going to go away is by adding cash, and that's always going to be fine. So we like to say you can offset mortgage boot with additional cash. You cannot offset cash boot with mortgage. Just think of it from the context. The government has no problem with you adding money to a transaction. They just don't want you walking away from a transaction with money. And you might think, well, hey, when I bought the property, I put X dollars in. I just need to reinvest the gain, let's say. And that's not true. I mean, you need to spend all the money out of that transaction. The first money coming out is in the government's eyes theirs. All right, it doesn't matter. You might have put 100,000 down when you bought the property. You think, well, gee, I should go get that out. That's not the case. After you've paid tax on all the other money, all the other gain, then you're entitled to get that money at the end of the day. So, the old saying, hey, I'm here from the government. I'm here to help. Not the case. Understand that it's easy to put stuff in, it's hard to get stuff out, and it's really important to understand the tax consequence on stuff coming out. And like I said, 1031 is not all or nothing. So if you don't want to fully satisfy the napkin test, that's okay. You're just going to pay tax on the difference and understand what the tax liability is going to be. But it's really important to engage your tax people and really work with them for tax planning. Don't just work with them for a tax return at the end of the year. I want to sort of flip back my comment on the like kind proposed change. They had in the late 90s, there was a proposal to get rid of the 45-day ID period, which would have been wonderful, I think. Now, there are lots of brokers, not lots of brokers, but there's brokers in my life, good friends, that they don't think that's a good idea because they feel people are going to procrastinate. It's probably the case, but like I said, I really, the 45 days, I've just been doing this so long, seen people that, it's just not good, but not like I have anything to say about changing it. So when they had proposed elimination of the 45-day ID period, they had bundled that with a change in the like kind requirement, and I'm glad nothing happened, because the change in the like kind requirement, at that point, they were concerned about the farmland being taken out of production. See any similarities today with who's buying these large pieces of farm property? But they didn't want the farmers just, getting out of the farming business and exchanging in apartments, so on and so forth. So they had proposed a like kind requirement that would be similar in service and use, which have been devastating because, as I said earlier, a lot of times people start with a rental house and they end up moving into apartments, and they end up going into industrial or big box single tenant or whatever it might be. And that whole progression would not have been possible if they had adopted similar in service and use. So that like kind requirement, the way it is today, is the way it's always been, and that's the nature of the investment rather than the form. Any real property held for investments, like kind with any real property acquired with the intent to hold for investment. So the ID period, we still have, but at least we still have the same like kind rules, and that would have been a tough deal to work with. But when we're looking at that napkin test and the value and equity requirements, understand, once again, it's not all or nothing. But you're really looking at anytime you want to add money to a transaction, that's fine. If you want to pull money out, that's where you're going to have the problem. And I guess a comment that I've got about pulling money out. If you want to pull money out of an exchange, you should do it at close. All right, you're either going to do it at close, and it's going to be basically excluded from the exchange. So if you're working with us, for example, when you tell us go, we're going to want a copy of the purchase sale agreement and the title report. We're typically going to get that from escrow. So what we really need from you to put a deal together, all we need is the taxpayer's name, address, phone number, email address. That taxpayer is the exchange, the person wanting to do the exchange. We're also going to want to know who's closing the deal. If we're talking New York, what closing attorney is going to be doing it. If we're talking about a lot of, most states these days have professional escrow companies too. So we're going to want to know the escrow officer's name, escrow number, and phone number. We're going to reach out to them, get a copy of the purchase sale agreement, title report. We're going to draw up an exchange agreement. We're going to draw up the assignment agreement, which is critical. That's a document that allows us to step in, assuming all rights and obligations of the person, that's relinquishing that property, and we're becoming a party to the transaction at that time through that assignment. Now, a comment on the assignment. Typically, purchase sale agreements, if you're working with a broker, I think you can probably thank NAR, National Association of Realtors, for this, but typically most states in their state forms are going to have, in that purchase sale agreement, it's going to have built-in boilerplate that says buyer or seller have the right or the option to do an exchange, which is great because it allows anyone to do it at any time. But on the downside, it's not telling anyone that you are. So it's really important that if you're doing, especially on a sale or a purchase via reverse, to let people know, the closers know, that it's going to be an exchange, so they won't close it without being structured as an exchange. Because unfortunately, even though code's over 100 years old at this point, we still have a number of people that come to us after a closing has happened, and then they're frustrated because nobody told them. So the boilerplate that's in the PSA will allow it to be done, but I would probably be the first to say it's a good idea to say, if your intent is to do an exchange, write in there an additional provision of the purchase sale agreement that it is your intent to do an exchange, or that you are doing an exchange. And it could be something as simple as buyer agrees to cooperate with seller's 1031 tax deferred exchange to no additional cost, liability, or obligation, something along those lines. And you put something similar on the buy side. So just food for thought. That thing, if you make it a term or condition, then escrow knows they can't close that. I shouldn't say they can't. They should not close the deal unless all terms and conditions of purchase sale agreement are met. So the continuity vesting, we talked about this a little bit, just means the taxpayer that relinquishes has to receive. Understand a partnership is the taxpayer. Even that partnership might have 10 members, that LLC might have 10 members. So it's really important. I tell people all the time when they ask, well, when do you want me to think about an exchange? I said, well, when you buy the property, because odds are you're not going to own it forever. But especially in a partnership, how often have you had a partnership in something where it just went into perpetuity? So it's really important to understand the plan for the disposition when you're making the acquisition. But obviously partnerships give a nice clean way to handle a property during the time of ownership. So you might have an asset that's owned by a partnership with you and 5 other people via limited liability company. I'm going to tell you maybe a year pre-disposition that you need to do that. I mentioned earlier, drops. You're going to have deed from the entity to the individual's tenancy in common, and then they have the ability, each tick is then going to own that property for investment pre-disposition, and then when it closes, then everybody can go do what they want to do. So it's really important that you're looking at these things, understand. The only dumb questions one you don't ask, but really plan ahead. Now, 9 times out of 10, that discussion never happens until you've got a sale pending. And I get a call, gee, the deal's in escrow. Or maybe we talked about a year ago, and now I get a call, the deal's in escrow, and I get a purchase sale agreement, title report showed that drop never happened. And that happens commonly because it's sort of cumbersome. I mean, imagine you've got a rental property, maybe it's an apartment building, you've got all these leases in place, you've got bank accounts, you've got management agreements, you've got tax returns. So to break it from that one situation, that partnership, that LLC, to every member having to do these things, it just doesn't happen a lot of the time. So 9 times out of 10 it's happening right near closing, and there's some vulnerability there, because did the individuals hold the property, quote unquote, for investment pre-disposition? And that's where you're going to need to talk with your tax and legal people to work through that. We're happy to help with that discussion. Obviously, we've been through that once or twice before. Now, if you're not comfortable with the immediate predisposition drop, then maybe we're doing a transaction where you're going out and buying a replacement property or properties. Maybe we go buy 5 different properties, each property in a different limited liability company with the exchanging limited liability company as its member. And then maybe a year downstream, you do an assignment of membership interest of each of those LLCs to its respective owner. So each member of the entity is going to go pick what they want, go buy it. We do the exchange for the entity and do 5 different replacement entities, and then a year downstream, each of those entities has the assignment transferring ownership to the respective owner. So that's an example of a swap and drop. But this vesting thing is just problematic for a variety of reasons, and it's really important, once again, to plan ahead. And as I said earlier with my diving comment, don't be forced into something. Don't just be pushed along to make something happen without really taking the time to discuss and make sure you're getting where you need to go. The timelines, we've talked about it, 45, 180 days, both start simultaneously with close. The 180-day can be trimmed by the due date of the tax return. So anytime we're doing deals late in the year, you've got to make sure you complete the exchange before you file a tax return. If you're not going to be completing the exchange until after April 15th, you're going to want to file an extension. So really understand what's going on there, but both those timelines are starting at settlement of that relinquished property. The property ID rules, you've got 3 rules, each is independent of the others. And this is one of these fallacy situations, right? Once again, people are under the impression that they can only maybe buy 3 properties or relinquish 3 properties. And in reality, you can relinquish and receive any number. But each of these identification rules, identification does not mean you've got a purchase sale pending. It just means you're giving what the government would deem an unambiguous description. That could be a common address, including city, state, and zip. You can change your ID anytime up until midnight the 45th day. And I would tell you this, we once again are going to talk about 1031 G6. Don't get to the 45th day and just throw something on there unless you're really sure you want it. Because if you ID something and then you decide you don't want it, let's say you ID something and on day 45 and it's something you really don't like, and then on day 60 you find what you really want, and now you want to go buy that other property. Well, we can't legally give you the money to buy that property, so until day 181. So it's really important that on the 45th day, you're either committed to completing the transaction or you should terminate the exchange. That way you've got the money, go do what you want to do. So, the ID rules, 3 properties, any value, pretty open. Second rule, you can ID more than 3 properties. Total value of the properties ID'd can't exceed 200% of the relinquished property's value. What's a property worth? I mean, is it worth what it's listed for? Is it worth what you're going to pay for it? Does a property have to be listed to be identified? It's really entertaining to me because if I go back to in 91 when my brother and I with another buddy started Equity Advantage, we had an audit manual, and that audit manual basically asked whether the property was listed at the time of identification, which is pointless. I mean, that's an utterly pointless statement. Property doesn't have to be listed to be purchased by anybody. So it really, a property's value is what you're willing to pay for it. So understand that 200% rule. There's probably some room in there with respect to what things are. What is something worth? Obviously, we have a purchase sale agreement in place. We've got 2 people that have agreed on a value, but I know I've got brokers on this presentation, and I'm sure every one of you has lost a deal based upon an appraisal. You're going, what did this person, how did they come up with this number? And it's one of those things where it's subjective, right? It's always going to be highest best use. But ultimately, if you don't have a sale pending, and we have the same issue when we're looking at our IRA 401k clients for required minimum distributions or the annual valuations on an asset, because you don't have a sale pending, you don't have those 2 people agreeing. So professional opinion of value, there's obviously some variation on what people think things are worth. So understand that 200% rule can change. Third rule, you can exceed 200%, you can exceed 3 properties, you got to close 95% of the aggregate value of all properties ID'd, meaning that you better close everything you've identified. So that's the ugliest of the 3 probably. And my advice is, if you're looking at a situation where you're relinquishing, receiving a number of properties, you probably want to get those things done inside the 45 days. If you do that, you don't even have to turn in an identification. So that's the safest thing you can possibly do. So once again, I stress each rule works independently of the others. Now, this is the fallacy, 1031 and number of properties. People say, well, yeah, the code says you can only relinquish 3 properties. You can only ID 3 properties. I can only buy 3 properties. It does not say that. You could give up 50 properties and buy 1, or vice versa. It's wide open. You just have to fit one of those rules or get the deal done inside the 45 days. So once again, I'm going to state this. There's no limit to the number of relinquished and replacement properties, period. Okay, you just, if you're working inside the 45, do what you want to do. After that 45th day, you've got to fit one of those 3 rules, which obviously we're looking at either the 200 or the 95%. And I'd say, you know, that 95% rule is just one of those things where it's stressful. You got to literally close everything you've identified. But you can relinquish and receive any number of properties in a 1031 exchange. This is 1031 G6, okay? 1031 G6, so, you know, if we go back, you know, let's say 25 years ago, somebody wanted to torpedo an exchange, meaning they want to end it, they started, they don't want to complete it. We'd give them the money, and you know, old Uncle Sam would tax it, and thought, hey, that's fine, and you know, Uncle Sam should be happy to get the tax revenue. Well, I can't remember, it's the late 90s. I believe one of the people in our industry had asked for letter rulings from the government on this topic, and government came back and said, nope, you got to follow 1031 G6. And you're thinking, well, gee, David, if I want to sync my exchange, pay the tax, how does that impact you? Why should you care, or why should the government care? Well, the problem is this, okay? There's something called an accommodating accommodator. You don't want to work with somebody who's going to work outside the fundamentals, those guidelines that fit in 1031. And 1031 G6 is one of those critical issues, right? If you don't follow 1031 G6, you don't have valid exchange. So the problem is, if I were to grant somebody that just wants out of a transaction and it wasn't per 1031 G6, our policies and procedures are flawed. Therefore, not just that person, but every exchange that we do is then in effect invalidated. So nobody in the 1031 world that understands it, that does it professionally, is going to give anybody money outside of 1031 G6. So if you want to pull money out of a transaction, it can happen at close, or after the 45th day if you don't identify anything, or after you've identified, if it's after the 45th day and you've identified things, it's after you've purchased all property you have the right to buy. So it's really critical. And just a comment I've got on the identification. So our ID form, to accommodate this situation, what we've done is we've got a series of blanks on there. You're going to fill it out. You're going to turn it into us, but you're identifying property. There's a paragraph down below the portion where you'd be putting addresses and everything, and it says, I have identified these properties, but I have the right to buy blank of them. Now, why did we do that? Because you might be identifying 3 properties or 5 properties to buy 3 or 5 properties, or you might be identifying 3 or 5 properties to buy 1 property. We don't know, but everybody's got different motives and different ways to work things. So the idea is that if the money comes to us and now you'd like to pull some money out, and you're in a situation where you're identifying, let's say, 5 properties with the right, you put 1 in that blank, you close you close out 1 property, we've got money left in the account, it's outside the 45 days, you're now entitled to that excess money. So if you want to pull money out of a transaction, it's either going to happen at close, and in our assignment agreement, there's a paragraph, section 8, I believe it is, that asks whether you'd like to retain any taxable proceeds. If so, how much. You put in how much you want to walk out escrow with, and that money's going to come to you at close. If the money comes to us, now it's stuck with us for whatever reason until after the 45th day. So even if you decide, hey, I don't want to do anything, we're going to keep it through day 45, day 46, you can have it. And then once again, if we look beyond that, then it's going to be a situation where if we're outside the 45, you've ID'd properties, it's going to be a situation where we can give you the excess funds after you've purchased all property you have the right to buy. Something just really important to understand, especially in today's market. Notes in an exchange. This is something, and this is another fallacy. People say, well, gee, you can't carry a contract or note trust deed to an exchange. Totally untrue. Yes, you can. There's 5 different ways to do it. And but it's got to be structured at close. And as I said earlier, we've had a number of transactions lately where people are selling on contracts of one form or another, seller finance, and they're being told they can just do an exchange when the balloon payment comes in. It's not true. That's a huge problem. Okay, so if you're doing a sale and you want to do an exchange and you're carrying seller finance, let's say a note trust deed. And we look at, once again, difference between note and trust deed. You're selling a property, you're receiving that note, and it's secured by the trust deed for that buyer, right? So the buyer takes ownership of the property. You've got a note secured by that. They default, you get the property back. A contract, title stays in your name until that contract's paid off. Either way, you've got a transfer of ownership. But typically, we're going to see note trust deeds today. For a variety of reasons, and they're way better for us to work with. But if you sell and carry a note and you want to do an exchange, just as the cash has to come, you cannot have actual or constructive receipt of anything at a close. Whatever you have actual or constructive receipt of, you're going to have tax exposure on. So when it closes, you've given us property, we sell it, the cash is going to come to us, so the down payment, and then that note is going to be ours at close. Now, what do we do with it at that point? We could sell the note to a third party. We could use the note to acquire replacement property. We could, the taxpayer, can purchase the note from us. You're going, David, why would I buy my own note? It's my note. Why would I buy it? Well, that note might be paying 5, 6, 7, 10%. If you sold somebody in the weed world, 20% on the thing. And you've got money sitting in the bank. I've actually had people borrow money from the bank to buy that note. Now, the idea is you're just substituting cash for the value of the note, therefore entitling you to complete the exchange totally tax deferred. Where if that otherwise that note's going to come to you, you've got some issues there, and we'll talk about them in a second. So that's why you buy the note from us. If you got, maybe it's a $200,000 note and you got $200K in the bank, what's the bank paying you versus what that note's going to pay you? And by buying that note, now you've got the income stream of that interest rate, and you've deferred the exchange, all the gain on the exchange, completing the transaction. The other thing that happens is maybe it's a short-term note. Maybe there's an issue. Maybe the financing fell out, or maybe the property's not financeable. So you're just going to carry a note for 30 days, 60 days, 90 days, whatever it is, if it's inside the purchase. So we want to wait until that balloons, then we'll complete the acquisition when that balloon payment comes in. So that happens a fair number of times. It's happened more lately just with the financing world and the economy we're in. The fifth option is just do a partial exchange. You're going to defer tax on the down payment. If it's large enough, you're going to pay tax on the installment sale on the balance of it. Now, big issues here, all right? Now look at that practice tip at the bottom. Understand that even if you don't get a single payment on this thing, principal payment on this, you're going to have, if you sell and carry a note trust deed or land sale contract, you're going to have tax on debt relief and depreciation recapture in the year of disposition. For those of you out there that are my vintage or older, you probably remember Robert Allen's Nothing Down book, okay? And it sounds like a great deal, but I've literally sat in closings where there's been virtually nothing down, and the broker's going, well, gee, how am I getting paid? The escrow says, oh, I want to get paid. I'm going, well, I'd like to get paid. And then on top of those closing costs, you're in a situation where you're going to have tax on debt relief and depreciation recapture. Now, a couple of weeks ago, we had a client that, once again, one of these people that are, all wholesalers buying this property and telling this person that they wouldn't, that they don't have to worry about the exchange till that balloon payment comes in. The other thing is, it was like a $10,000 down on a $500,000 deal. Okay, $10,000, what's that going to cover? That person was going to be subjected to some tremendous tax consequences just on the depreciation recapture, let alone covering carrying cost or the closing costs. So make sure if you're doing a seller carry, you're getting enough to do what you want to do with it. Understand the repercussions. So once again, talk to your tax people about what's going on. Another fallacy, flipping is not investing. Okay, that's not the fallacy, that's the statement. People that flip properties think they're investors. They're not investors. That's a business. So in a business situation, you got two problems. One, you're never going to look at long-term capital gains tax treatment on a disposition. Two, 1031 doesn't apply. So, yeah, and we've all probably heard at this time, the market's been just so easy since the last crash that you've got all these TV shows, talking about flipping properties, and you've got all these organizations that basically promote it. You got the gurus on YouTube and everything else talking about all this flipping and wholesalers and retailers and everything else. And the deal is, this BRRRR acronym has come out too, like it's this new novel idea. People have been doing this for decades, all right? So the idea is, instead of just buying, fixing, turning and looking at paying normal income tax on things because you're a dealer, the idea is you buy it, fix it. If you want some money out of it, the increased value you can pull out via cash out refinance. And at the end of the day, if you look at what you've got in your pocket via the refi, and then you hold it for a year or so, then you do a 1031 exchange, because you buy things. How often are you going to hold it forever? Now, there's a statement, why would you ever sell good real estate? And hey, I would agree. Some of these properties that I've had through the year, I would love to still have them. Love to have some of my old family stuff, but the idea is, if you just buy it and turn it, you're paying normal income tax. That BRRRR thing, you might do the buy, rehab, rent out, refi, and hold it for a period of time where you can go from short term to long term. That's good. That's a step in the right direction. But why not integrate a 1031 at the end of the day? And if you start looking at that, as long as you've held it for investment, then you're going to be able to do the exchange. The refi money, is going to give you some nice cash. The money that's left in the property, if you just sold it, the property's gone, you lost it to tax. But if you look at what your tax hit is versus what a cash out refi is going to leave you, the money that's left in the property is probably in excess of what you'd be putting in your pocket after taxes. So that whole process works great. We've done that, in this business for 32 years now. We've had clients doing that stuff and worked with them doing it. So really understand what you're doing, take a look at it. I understand when somebody getting started in that situation, in that business, they got to sell, they got to get money just to move to the next thing. But really at some point, you got to understand what's possible. Understand that if you're paying tax on this stuff, it's because of your choices, your actions, and understand, talk to people that have done this stuff and really work with people that are going to help you keep your money yours. So one of the things we like to say around here is, you've worked hard for your money, we work hard to keep it yours. And as I said, if you look at that acronym and you just toss in the 1031 at the end of the day, it allows you that liquidity, that ability to go from asset to asset without having to pay the tax. And that tax consequence, understand, is something that is going to be quite substantial if it's normal income tax. Even if it's a long-term capital gains tax, it can be pretty consequential to you. Now, when we're looking at this stuff, like I said, it's a business. So dealer status is something we take very seriously. I look at this Clarkowski court case. When I'm looking at my IRA 401k clients, I work with this court case to determine whether somebody's subject to UBTI, unrelated business taxable income, which is dealer status once again. 1031 world, we're going to look at it to see whether the property fits for 1031 purposes and what kind of tax consequence is going to be there. So, one, what was the purpose of the acquisition? Two, the purpose for which the property is held. 3, the extent of improvements made. 4, frequency, number, continuity of sales. 5, extent, nature of transaction of the property. 6, general business activities of the taxpayer. 7, the extent of advertising promotion of the property for sale, whether the property was listed with a real estate broker or other outlets. And 9, the purpose the property was held at the time of sale as opposed to the time of acquisition. Number 8, the reason that's important is because you could buy a property, and if we look at required hold periods, there isn't one, all right? It has to do with intent. So you could buy a property and a month or two after acquisition, you could receive an unsolicited offer that was too good to pass up. Your intent was to hold this thing. The nature of that transaction changed with this unsolicited offer. If you bought the property and listed it and it took a couple months to sell, you didn't hold it for investment. It was held for resale all the time. So there's a court case, this Racine court case, where 4 months was deemed long enough as a hold period. So people exchanged out of a property they didn't want into a new property, documented listings, documented showings for lease, couldn't lease it up, argued hard. They ended up moving into that property, selling their home. They got audited, argued hardship. They couldn't afford to hold both. And they actually successfully defended that in court. So, 4 months in court, was found long enough. I can give you a court case where 5 years wasn't long enough. And you're going, David, how could 5 years not be a long enough hold period for 1031 purposes? Well, it comes back to this business issue I was talking about earlier, or what's being done with the property. It just took 5 years to sell. So the people bought the property. It was on the market from the date of acquisition pretty much. It took 5 years to sell. So they held it for resale the whole time. So it's really critical. Time is not the deciding factor. You're going to look at a variety of things. If you look at that Clarkowski, court case, 9 points used to determine dealer status, you've got a couple of strikes against you. That doesn't bother me. 9 times out of 10, dealers are going to have all of those, going against them. So, boy, if I'd gotten started on time, we'd be doing okay. Related party transactions. So another fallacy. People say, well, gee, you can't exchange with a related party. Well, that's not true. You can. Typically, in an exchange, it's considered okay to sell to a related party in exchange, not okay to buy from a related party through an exchange. Now, the exception is if both parties, so if you buy, the exception is if both parties are doing an exchange, both parties hold their respective replacement properties for no less than 2 years. That's fine. Now there is in the fine print of the code, it talks about, well, unless there was no intent to avoid tax, then even the 2-year wouldn't apply. But with related party transaction, I want to stress this once again, selling to a related party in an exchange is typically considered okay. Buying from a related party is not, unless each party is doing exchanges and each party is going to hold their respective replacement for no less than 2 years. You can read the fine print, and that that avoidance of tax thing comes in there. Some people say, well, 1031 is avoidance. Well, no, it's not. It's deferral. But it's one of those things where anytime you're working with a related party transaction, I really advise you to talk to your tax people about the situation. A couple examples. We're out of here. If you've been to my class before, you've probably seen these. So just hang tight, but we'll be done in a second. So this is an example of not all or nothing, right? So this is a transaction where we had a couple that was relinquishing a $3 million apartment building. All they wanted was $1 million replacement property. So they went from $3 million down to $1 million. They had tax exposure on the $2 million in gain. And you're going, boy, that's a big tax hit. And yes, it was a big tax hit. But they still were able to defer the difference on $750,000 in gain. So the basis on the relinquished property was $250,000. They spent $1 million on the replacement. So every dollar you spend over your basis represents tax deferred gain. So they went from the $250 up to $1 million deferred tax on $750, saving $250,000 in tax. So I never judge clients on what they're trying to do. I try to inform them, let them know sort of what they're looking at. I have people that refuse to pay $5,000 in tax. I've got people that, oh, the tax, it's only $1 million bucks. I don't care. Well, everybody's different, and I'll tell you that somebody's selling a $75,000 house, that $5,000 tax hit, that's a big problem, right? So everybody's different, and I never make assumptions on where that threshold's going to be. And in this case, they were okay going from 3 to 1. And they still, saved themselves $250,000 in tax doing that transaction. So, this is a situation where, once again, if you look back, one of the first slides we talked about that 1031-121 slide, what people are selling. And this is a situation where you think about section 121, it came in 97. Now, I would argue that the old 1034 rollover is probably a better situation for a lot of people today than 121 is, because 250,000 in gain individually or $500,000 for a married couple doesn't go very far for, pretty much anyone on the West Coast or, any high value state. I mean, look at the cost of property in Florida or New York or anywhere these days. I mean, it's really gone up a lot. I mean, I think about when my brother and I started, when we started working on residential rehab properties, and the cheapest house we bought was $23,000. So I mean, that was a different world. You know, today you're just looking at the cost of things and you look at the exclusion. So we've got a lot of people that will come to us, and really, if you've got a high dollar home and you don't want to pay the tax on disposition, or you don't want to pay the full tax, the first thing you're going to do is move out. And that's what these people did. They got referred to us by a law firm. We told them to move out of the house, establish it as an investment property, and then they sold. You know, I can't remember, a little over a year later. When they sold, they were entitled to the $500,000 exclusion. They were married, and then the overage went into 1031, and they went from $1 million tax hit to zero. Got 24 different replacement properties, closed them all inside 45 days because they didn't want to deal with the 95% ID rule. If one sale failed, it would have been a problem. So, you know, it's just sort of success story, big difference. Now, if you don't want to move out of the house, but you don't want to pay all the tax, I'll tell you the other way you can mitigate some of the tax exposure on a high value home sale is by using the QOZ or OZ, Qualified Opportunity Zone or Opportunity Zone. And if you've got you know, desire to find more information on that, you can talk to somebody, for example, Inland Private Capital, or you know, there's a variety of different companies out there that are doing that that business. I've got a good buddy, Greg Genovese, and we've got, you can take a look at our YouTube channel, his company, USG Realty Equities. He does an amazing job. I walked through one of his projects in Tacoma, and just a neat deal. But Greg's a great guy. He'd be happy to answer questions. Take a look at our YouTube channel. Just type in Equity Advantage, Opportunity Zone, and Greg and I put a nice series together so you can learn a lot on that stuff. Another good friend of mine, Connie Rathbone, there's a series on those things also on our YouTube, and she's dynamite on this topic. And I think you'll learn a lot if you want to know more about it. But the reason I bring it up once again is if you got gains in excess of 250 or 500, that you're going to be able to utilize that OZ or QOZ process to mitigate some of your tax exposure. It's pretty neat process. So, all right. And I would also say that if you're looking at a failed exchange, you can apply that too. So if you're in a transaction where you're not finding what you want and you terminate the transaction, you fail to complete it, take a look at the QOZ, and that might be the solution to help you out and get you where you, at least partially where you want to go. This last slide has nothing to do with 1031. It's sort of my curveball. I just love it. It's sort of, I hope it entices you to come listen to one of our IRA 401k presentations. But this is an example of what's possible with a retirement account. Once again, in times like we're in, a lot of people will move from one company to another, and you might have a corporate 401k plan. Well, when you leave one company, go to another, you've got the ability to roll over that plan. You could roll it into that new company's plan, or you could just take and self-direct it. So in times like we're in, we have a lot, the retirement side of our business really picks up dramatically. But this is a situation where a retired couple came to us, and each of them had an IRA, and they said, well, gee, we'd like to go out and buy this mobile home RV park. I said, okay, we can help you with that. And typically what we would do is we do what's called a checkbook IRA, which in a nutshell means we're going to create a limited liability company. The membership of that limited liability company is a trust company for benefit of his and her IRAs in this situation. They would be the manager, the trust company is the member. So they would then just negotiate the purchase in the LLC's name, buy the property, and they can manage the asset. Well, they then told me they wanted to be the on-site managers to be compensated for that. Both of those things would constitute prohibited transactions in the IRA 401k world. So we shifted gears into something called a rollover business startup. Instead of using IRAs and a limited liability company, we used a 401k plan, a C Corp. So moved the funds, those IRAs, into the 401k plan. The 401k plan bought the corp bought the park. They got an investment, a place to live, and a job, all with that one transaction. And I just think that's really amazing. It exemplifies all that is possible in that side of the investment world. 1031 is not always the right thing, and if you're having a hard time falling asleep, sometimes you can go take a look at the YouTube channel once again and look at, we've got a presentation on In-Games that goes through all these things, but you can swap till you drop. At least that's intact today, meaning that you exchange, you pass away, yours get a stepped up basis current market value. You can exchange into a retirement house, something that's held for investment for a period of time. The conversion doesn't trigger tax. You move into it, you can live there into perpetuity, right? Don't look at that conversion into a home and then a future sale as something that, hey, I'm so smart, I'm going to get rid of all my gain by exchanging into a property, living in there for a few years, and then selling it and taking the exclusion. It doesn't work. One, there's a 5-year required hold. Two, there's something called the Housing Assistance Tax Act that applies. And if you've got questions on that, you can give us a call or once again, take a look at the YouTube stuff. Structured installment sale, we talked about earlier, and just be forewarned on that. Understand you better get enough of down payment to cover all the closing costs and understand what's going on with that. And it's got to be structured at the time of disposition. Structured sale is an institutional structured installment sale. So the problem with a regular installment sale is you've got the possibility of acceleration of the payout. You've got the situation where the buyer might default. Maybe you just don't want to deal with all that stuff. So a structured sale, basically a third-party assignment company comes in and assumes the obligation to pay you. So you can literally term that payoff over the time that you choose to do that. An UPREIT, I sort of feel like it's the ultimate installment sale. You're completing the exchange into a Delaware statutory trust that then rolls via Section 721 into a real estate investment trust. The beauty of that is that you ultimately end up with an installment sale without having the tax on debt relief and depreciation recapture. The vulnerability you've got is obviously the REIT can go up and down in value, but then as you sell the shares of the REIT, you pay the tax on those sales. The only downside of the UPREIT is it's a dead end. You cannot exchange out of that at the end of the day, where DSTs, institutional TICs, you can go in and out of. But if you want to go into a REIT, that's the way you're going to do it. You're going to go into a DST via 721 into the UPREIT. Deferred sales trust is another sort of form of installment sale. Charitable remainder trust, you've got some charity that you love, you want to get some tax benefits by donating the property to them, you can do that. We've got content on that online. Institutional tenancy in common, obviously, the DST stuff. So if we look at the difference between a DST or a institutional TIC, DSTs are typically going to be multi-asset offerings, meaning you're going to buy into a portfolio of properties or stabilized assets, totally non-recourse debt. You cannot have a capital call, right? If it's an institutional TIC, typically they're going to be used because it's more of a value add play. They're buying the asset and do stuff to it. It's not quote unquote stabilized, but you're going to have probably more of an opportunity for an uptick in value with the institutional TIC than the DST, although our DST clients have enjoyed very nice returns through the years. But those are two different forms of passive, that classic mailbox money. Oil and gas, yes, it's possible you can actually buy into certain oil and gas interests. If you want to know more about that, you can, my buddy Troy Eckert Oil and Gas out of Dallas, I've been blessed to be involved with them for the last few years, and we've got some information online now, or you want more, reach out to us on that. Gifting. So you've got properties, you got a couple kids, you want to give the kids the properties. Understand it, as you get older, you're looking at a state tax situation, you're also looking at capital gains tax situation, maybe you want to transfer assets. I can't believe the number of times people just quit claim a property to somebody. Well, you quit claim a property to somebody, you've given them all the equity in the property. So if that equity is in excess of the gift tax limit, you're going to have, the person granting the gift, has tax consequence. So the idea is that when you're gifting an asset, if you gift it in pieces, there's actually a possibility of taking a discount on that valuation. So if you gift a minority interest in an asset, they don't have control of the asset. Therefore, what they've received can be discounted up to 40%. So you can accelerate transfers while minimizing the tax consequence by doing fractional gifting and minority interest gifting and utilizing the discount. That's once again why you need very good tax people, but this is something that's done. Opportunity zones, QOZs, we talked about that. Exchange until it makes tax sense. What do I mean by that? Maybe you have a huge year this year business-wise, big tax hit, maybe next year you got losses. So time those sales when they can be offset. So once again, tax exposure is one thing, taxes owed is another. So you're timing those dispositions to offset other things that maybe would mitigate that tax consequence. And then more frequent and smaller transactions are being done today. So just be aware of those things. Thank you so much for the time today. We are done. Please, take a look at our YouTube channel and like and subscribe to it. Really helps us out. If you've got questions on different things, you'd like to have us provide a presentation on something that you've got questions on, please don't hesitate to reach out. The only dumb question is one that's not asked. And we look forward to speaking with you soon. This just shows you a few of our different business offerings. But thank you so much for joining us today. I hope you got something out of it, and I look forward to speaking with you soon. David Moore, Equity Advantage, 1031exchange.com. Thank you.